Yes, so my panelists for this opening session for our LPGP dynamics is, I'll just briefly introduce the panelists. There's Carl Rodrigues. He's the he handles private equity partnership investments. He's a member of the management group at Partners Group. There's Goi Hai Huang. She is the head of alternate investments in Asia for Pictet. Then there's Audrey The-Dumas. She's the managing director for Cambridge Associates. And Dr. Thomas, I'm sure most of you know him during a stint with SVCA and CDH. He's the Chief Executive Officer Singapore, head of Southeast Asia, and co-head for global cross-border transactions at CDH. I've got a very sort of esteemed panelists. There are two GPs, there are two LPs, so it'll be very interesting to sort of hear from both sides. But before I actually start off with my questions, it'll be great if maybe all of you can take 30 seconds to just introduce introduce yourselves and your firm for the benefit of our audience. Yeah, Carl, we'll go with you first.
Sure. Carl Rodrigues. Don't be fooled by the Portuguese surname. Singaporean, born bred. Been with Partners Group close to 11 years. I worked on sort of both sides of the private equity groups within Partners Group. I did 5 years of lead buyout transactions across Asia Pac, and now I'm with the partnership investments team that does fund investments, secondaries, as well as direct co-invest.
Yeah.
So good morning, my name is Hui Yang, and I head up the alternative investment team at Pictet. The Pictet Group has been around for more than 200 years. We are privately owned, and we're run as a private partnership with a long-term mindset. So our scope of the businesses includes wealth and asset management, custodian asset services, as well as the alternative investment platform, which started back in 1989. So the AUM of our business is about 50 billion. We have about 200 professionals located in 11 offices. We are independent, and we're an investment-led firm. Thank you.
Good morning, everyone. My name is Audrey. I'm a managing director here at Cambridge Associates Singapore office. Cambridge Associates, not quite as old as Pictet, but we're 50 years old this year. We've been in Singapore since 2001, and I first joined the firm in 2007. Collectively, this is my 14th year at the firm, where I work with investors in the region, including endowments, pensions, sovereign wealth funds, as well as family offices, on constructing custom private investment portfolios. So what that means is I look across a variety of strategies from PE, VC, all the way to private credit and private real assets. It's great to be here.
Dr. Thomas?
Good morning, my name is Thomas Lanyi. I lead CDH investments activities in Southeast Asia. Most of you will know CDH investments as an alternative assets management platform focused on investing in China. We manage the activities outside. CDH has been active in this part of the world for about 12 years. I've been here for 22.
Yeah. Thank you all, the panelists, for the introductions. I want to start with the GPs, both of you. Carl, I'll start with you. Broadly, just one round of big picture questions. Want to understand from you what has really changed as a GP in the fundraising circuit in the last 12 months. You know, as a lot of LPs are sort of struggling with realization and liquidity concerns. Has that forced a lot of GPs to change their reshape their expectations as they fundraise?
Well, yes, I think about 18 months ago, it was looking like the fundraising cycles were getting shorter. And traditionally that used to be about 4 years between funds. But as we approached 2022, the fundraising cycles were seeming like sort of 2 to 3 years. And that's on the back of, in Asia, private equity becoming a lot more pervasive. And as more businesses started to partner with private equity in more emerging markets, and in more developed markets, you saw a lot more corporate carve-outs. So the pace of deployment was really accelerating. And as the pace of deployment, accelerated, LPs were also willing to give GPs the benefit of the doubt based on their historical track records. LPs like pension funds, insurance groups, they were also looking to increase their allocation towards private markets. And if you look at sort of liquidity and exits in Asia over the sort of previous 6-7 years prior to 2022, they were also running at a decent clip in terms of liquidity, over 110 billion of proceeds per annum. But since the second half of last year, things have changed rather dramatically, triggered initially by the war in Ukraine. Then you had rising inflation, rising interest rates, and ultimately that led to a lot of market uncertainty. And really, market uncertainty is what is the biggest dampener of private equity activity. And I'm sure you guys have seen the reports, in whether it be Prekin or Bain reports. The number of exits have fallen off rather dramatically. I think Bain has that number for the first half of this year being something like 65% down. So liquidity has really sort of dried up in the market. To compound issues, you have geopolitical tension between China and the US. And all this sort of exacerbates the whole issues that we are seeing in the fundraising market. And the sort of confluence of all these factors that I just described has led to a rather challenging fundraising environment. We have observed GPs formally requesting for extensions to their fundraising timeline. We've seen GPs sort of tapping secondaries market for liquidity solutions, LPs doing that too, and just overall general delay in the whole fundraising environment. That's what we're seeing in the current environment right now. And some of these GPs have had to be quite creative. I talked about secondaries, and some of them are even tapping a broader LP base now. Those who are innovators and able to come up with sort of evergreen type structures are able to tap the retail segment of the market. But yeah, so a lot of creativity as a result of the pressures that we're seeing in the market.
Got it. I think we'll touch upon a lot of those points that you mentioned through the course of the panel. But thank you for giving us a big picture view. Dr. Thomas, let me come to you. When you
Just Thomas.
Yeah, okay. Yeah.
Thank you.
So let me ask you, when you were introducing yourselves, you said you've been here for 22 years. Yeah. At times like this and in a market like Southeast Asia, how do you sell the Southeast Asia story to LPs, especially in these times?
Yes. I'm afraid I won't be a hell of a lot more optimistic or positive than Carl just now. I think if we take a big step back, this is clearly a very challenging environment for our industry. Private equity and venture capital are facing significant headwinds at an asset class level. I mean, I'm talking to LPs, so probably no point beating around the bush. Many of you are currently suspending your investment activities or are actively looking to reduce your exposure to this asset class. That is understandable on the basis of revised views on risk, return, liquidity, holding periods, and what have you. So many of you probably feel over-allocated at this point, and that means it's not a great time to convince someone to deploy significant amounts of capital into a risky, illiquid asset class tied up for long periods of time. Now, in an environment that is risk up and risk appetite down, try and pitch someone a proposition in an emerging market is doubly hard, I would think. Fortunately, there are some people that are interested in the Southeast Asian story and opportunity. I'd like to think some of you would have made a commitment to this part of the world a long time ago and consider Southeast Asia a permanent part of your strategy. And in other words, you're perfectly familiar with what to expect and the positives around this part of the world for private equity. My point, and I'm trying to finish on a positive sort of a note, is that the battle will ultimately be won not on the macro front. it's a micro front. It's manage the selection. And so if you have your track record, you have your team, you have your post-investment value creation capabilities, you have your history around exits and liquidity, you are structurally flexible, and you're generally pursuing a model that's aligned with LP interests, I think you stand a chance of raising capital even in this environment.
Interesting. Huyang, let me come to you. What are the opportunities that you are seeing as an LP in the current environment?
Well, I think broadly to start with, in this sort of an uncertain environment, alternative investments are more essential than ever. And so here, alternative investments, why do we talk about alternative investments? Firstly, alpha generation. Secondly, volatility reduction, dampener. And thirdly, we're talking about portfolio diversification benefits. It tends to have a lower correlation to the public markets. So alternative investments at large, probably more widely known as private assets. So for private assets, it's been proven, right? Historically, we can look at statistics, that private assets is able to generate value and compound attractive risk-adjusted returns over long term. So if we were to sort of look into the subsegment, in the private equity world, there's a path to creating value, and that is about operational value improvements, right? We're talking about really having a plan. How do we help the company increase its EBITDA? Whether it is not just about sort of cutting costs, it's also about how do you drive the top line, revenue growth, new regions, new products, new services. If we talk about, say, real estate, why is real estate potentially an opportunity set? Well, because it's twofold, right? It can generate income. It is also for capital appreciation. And if you look at lease rentals in this sort of environments, it tends to be indexed to inflation. So, plus the fact that lease rentals gets renewed, every 1 year, 2 years, 3 years, or 5 years. So you get to renew it at whatever the rate is currently in the environment. We also talk about private credit. I think that has become increasingly very topical. People are very interested in that. Private credit is actually a different kind of asset class with strong structural downside protection. So in an environment where it's becoming more and more challenging, right, operationally for businesses, you want to be protected in the event of default or liquidation. You are actually ranked much higher in the capital structure, so you have that downside protection. And if you look at, there's another asset class which I would like to mention here, last but not least, I would like to highlight is hedge funds. Hedge funds, depending on how you classify, it's not exactly private, right? Kind of a hybrid because, it's not like a 10-year lock, neither is it a daily liquidity. But hedge fund is actually very interesting because we are now living in a macro paradigm. We're witnessing this macro paradigm shift, right? Whereby there's so much uncertainties geopolitically. And if you look at sort of divergence, macro monetary policies, you look at very stubborn high inflation rate and interest rates. What this throws out are opportunities whereby you can actually arbitrage. So hedge funds, the beauty about hedge fund is that you can be very nimble. That's what hedge fund is. It's not just about long position. You can express your investment views by taking a short position. So these are what we're generally seeing in the market right now.
Yeah. Audrey, let me come to you. Are you seeing anything different in terms of how LPs are thinking strategically, especially in the current environment?
Yeah, thanks, Joji. It's definitely been interesting times, to say the least. From a strategic perspective, thinking about your portfolio, reviewing your portfolio, that's just a case of good portfolio management hygiene. So from a strategic asset allocation perspective, in terms of what we're seeing investors and our clients allocate to private investments as a whole, I would say, generally speaking, many of the investors that I work with in Asia have not suffered as much from the denominator effect that we've seen from the West. part of the reason is because many of these portfolios are younger, so perhaps the downdraft in the public markets has actually resulted in them getting to targets faster, but not overly allocated. So what that means is, given what we're seeing in this market environment, I think you're going to hear that, yes, it's challenging, but likely there'll be some bifurcation in terms of who the quality players are and who will sort of die on the vine. Is that valuations are also likely to be more attractive. So as a result, from a strategic asset allocation perspective, we are seeing investors, some are initiating new allocations to private investments, so they've never invested in the private markets previously. Some are thinking about increasing their allocations for the reasons that Hui-Yang has mentioned, that long term, I think you've seen private markets deliver sort of outsized returns relative to the public markets. And some are thinking, hey, beyond PE, VC, what else can we invest in across the spectrum of private markets? And that goes to whether it's private real assets, infrastructure, renewables, or even private credit, which is obviously very interesting in this rate environment. So I think, all in all, we are seeing still interest. We are seeing intentional sort of strategic decisions to increase allocation to private investments, but building that multi-purpose portfolio that can play different roles in the portfolio.
Yeah. I just have a quick related question, especially in this part of the world. There's a lot of mid-market, lower mid-market funds in Southeast Asia. How are these GPs being impacted in the current environment? Do you think it's they face the toughest times ahead?
Yeah, I would say if we just look, if I can just bring this back to the overhang that we're seeing in the market, and these are global figures, but there's something like 1.2 trillion in PE VC market overhang. So what this means is that this is capital that's been committed but not yet deployed. So there's a lot of dry powder that's out there. About 70% of that's in the US, and then the other sort of split equally between Asia and Europe. Of that, 70% of the dry powder, or 50%, more than half of the dry powder in private equity is to firms above 5 billion. In venture, that's about a third of that is in firms that's raised greater than 1 billion. So generally speaking, for mid-market opportunities, which seems to be a good fit with the market segments here in Southeast Asia, if the GP has the right toolkits to source, to add value to these companies, there is that huge amount of dry powder, whether it's raised by Pan-Asia funds in this region, that you can actually sell out to, or have multiple, sort of options to exit. So again, I think, it depends, Joji, but I would say from a market segment perspective, it does get more interesting, whether it's from a sector specialist perspective and from a multiple options, exit options perspective.
Yeah. So related to dry powder, let me come to Hui-Yang. Let me just, you spoke about the opportunities, mentioned several opportunities that you see. I wanted to ask you, what about co-investments? In times like this, do you see a lot more LPs increase co-investments, and also that also helps reduce fees, give you more exposure?
Yeah, you hit the nail on the head, right? Fee is a big consideration. So indeed, we have been and we continue to see a huge appetite for co-investments amongst our peers when we look around. And why is that so, right? Simply because there's a line of specific sight to the deal. You're looking at a single business, you're looking at an asset, looking at a business, and you form a view, you build a conviction whether you want to double down on that deal, right? So it's just contrast that with fund investments, right? Because you're investing into a fund, you buy into the strategy, but you won't know what you get in the portfolio until the construction is over and done with, which is several years down the road. So it's the visibility, number one, and number two, as an investor, you get to exercise your choice. Do I like this partner in this particular co-investment, right? Does he or she, the firm, has got the expertise, right? Are they able to actually create value and help me generate the gains? So you get to pick and choose, because I think every manager, every firm has got their strengths. They've got their niche strategy, their, their network in a particular region, a particular industry skill set, which can be, very useful, and you bring it to bear in a single co-investment deal. And then, as you said, right, I mean, economics, who doesn't love attractive economics, right? Be it reduced economics, or sometimes, if you're lucky, no fee, no carry. That will overall, sort of enhance your investment returns. So definitely the case.
Got it. Yeah, just coming to the GPs, Thomas, let me start with you. In times like this, how do you broaden the LP base? Because there are others interested in putting money into private equity. It could be family offices, it could be private wealth. So, and how do you convince them to sort of put capital into the private equity asset class?
Okay. So we've traditionally tried and cover as broad a spectrum as possible in geographic terms and also in LP cohort terms. We have a fully dedicated in-house IR team that essentially leads the effort and is supported by the investment professionals. There is for the time being, I guess, there's bright spots geographically speaking. If you think about the Middle East, family offices, private wealth, potential pockets of growth, if you will, from that perspective. Having said that, as I said earlier, we're currently at a point in time where it is very challenging to find LPs that are willing to commit capital into new relationships or new geographies, potentially. It'd be my view to prefer focusing your efforts around the existing LP relationships that you already have, people that are familiar with you, with your team, with your strategy, where there's long-lasting relationships and mutual trust. People that have essentially bought into your proposition, and focus your time, effort, and resources to see whether you can raise more capital around those existing relationships, as opposed to spreading yourself too thinly, traveling the world for that one new LP relationship.
Yeah. Carl, let me come to you. In your opening, like when you were talking, giving us a big picture view, one of the things that you mentioned was the secondary space. Partners Group is a big player in the secondary space. In the current scenario, how do you see the secondaries investment space evolving, not just globally, but particularly to Asia?
Yeah, I think the whole secondary space is one of those bright spots that Thomas was talking about as well. I think secondaries investors play an increasingly crucial role in the whole private markets ecosystem. Secondaries are essentially liquidity solutions. And as we all know, private markets is perceived as an illiquid asset class. If you invest into a fund, you start to see liquidity around about year 6, 7, 8 before you get any meaningful returns. And secondaries have, even up to before this whole issue post-Ukraine crisis happened, has already been a significant source of liquidity, and for sophisticated LPs who have been tapping this market in terms of rebalancing their portfolio or strategically repositioning their portfolio, LPs have already been tapping this market for a long time. And as a result, the secondaries market has grown at north of 20% over the last 5-10 years. So it's one of the fastest growing subsegments within the whole private markets industry. To layer on top of that, you have GPs as well, who are becoming increasingly sophisticated and tapping the secondaries market for liquidity solutions. In the past, when GPs tapped the secondary markets, it was sort of seen as a slightly negative thing. You maybe had a bunch of tail-in assets that you couldn't sell and couldn't get rid of, and you tapped on the secondaries guys in order to clean those portfolio assets from out of your fund. But increasingly these days, you see secondaries investors picking up champion assets of GPs, putting those assets into continuation funds, and backing those GPs for the next leg of that journey. So sort of these factors are sort of driving the overall growth in the secondary space, and I think that segment is one real bright spot that we can look on.
Yeah. Just want to change track a bit, focus on 2 or 3 quick issues. We have another 15 minutes. Audrey, let me start with you. In the current environment, we're seeing a lot of GPs raise vehicles that, where they're not specialists on. A lot of people are raising, climate tech funds, sector-specific funds. Some are doing new country-specific funds. We're seeing others do private credit funds. These are not typically the specialty of the GPs. How do LPs look at these?
And we talked about a challenging fundraising market. I would say my first reaction is I worry quite a bit when you're doing something that is not in your sweet spot, or something that you've got sort of a relevant track record in. Some of what you've mentioned is very thematic. So at the end of the day, I think it comes down to manager selection and asset selection. This is something that Dr. Thomas had mentioned as well. Right, is there a team that is well positioned and experienced in executing across any of these areas, right? Have there been a track record of similar deals? Many of these GPs actually have done some form of these deals in their flagship funds. And so sometimes it is a growth of, not that, it shouldn't be, let's just raise something because it's cool today, but if it's a growth, sort of a natural growth of what they've been doing, and it's time to raise something separate that is complementary, that could make sense. But I think at the end of the day, it comes down to sort of vetting the GP and whether or not they've got the differentiation and the experience and the expertise in terms of investing in these new areas. And sometimes there is no track record for many of these newer areas, such as climate tech. So, outside of understanding or trying to measure if there's a track record or not, it's about referencing and trying to triangulate whether there is truly a differentiation. And because I think at the end of the day, there is an opportunity cost of committing to, in a capital constrained world, there is an opportunity cost where you put your money towards. And so, I think LPs will definitely, we've been taking a very keen eye and making sure that we're making the right decisions there.
Yeah, I have just one more quick question for you. If you look at the US or Europe, one of the things that we've seen many LPs do is they sort of come in and make co-investments before going to do directs. But in Southeast Asia, we've not seen a lot of LPs do directs. Why is that? Is it the size of the market, lack of opportunities, no feet on the ground? What do you think could be the reason?
I really think you have to align how you execute your private investments portfolio with the resources that you have. And so with that, it's about scale and staffing resources. Dealing in co-investments and directs, quite different from investing in a fund in terms of skill set. So we do believe that private investments is a full contact sport, so you want to use all the levers of primaries and co-investments and secondaries, which actually I agree with Carl looks very interesting today. But given where many investors in this region are, we talked about how many of them are newer to private investments, depends on what they have in terms of skill sets in-house or externally. Many start with primaries first, having sort of foundational portfolio, and then adding on co-investments and later on directs. And perhaps it's a reflection of where they are in that private investments journey, and also a reflection of where the market in Southeast Asia is in terms of further proof points and exit options. I think once we have more clarity on that, the decision to put that dollar to work will also become much clearer. So I think we are still somewhat in the maturing phase of that, Joji.
Yeah, thank you, Audrey. Huyang, I want to ask your opinion on 2 things. One is manager selection. What has changed in the current environment? What are you looking for?
Yeah, I think in this sort of challenging environment, it is very important to understand how managers generate their returns. I think we all know traditionally there are 3 ways that you can generate returns. Leverage, leverage hurts as well if it's go down, right? But it obviously boosts your return if everything is rosy. And multiple expansion, really market sentiments, IPO markets, it's all not within our control. What's within our control is really the value creation plan. So I really think that it's important to look at the managers and see and ask, understand how do they generate value for their portfolio company? Do they have a team of people who are able to actually help them operationally, the portfolio companies? More importantly also, well, just as important is also about navigating this sort of difficult environment. I think we're in unprecedented times, right? I mean, for a long time, interest rate was so low. And now we have like persistently high inflation rate. So are our portfolio companies able to pass on some of this inflation costs? So you sometimes can help the portfolio companies, and that's where you really see who are really the better managers at helping the portfolio companies through challenging times like that. And you talk about just kind of aligning what we were just talking about, new strategies, climate, and innovation and whatnot. So, or AI. So the question is, does the team? It may be a very established firm, but is it a new team? Do they have the relevant skill sets and the experience to actually execute the strategy, albeit it is a very relevant strategy in current time?
Yeah. Related to managers is one more question is, how do you look at first-time managers, especially in such times, right? There's enough data to show first-time managers, at least many of them outperform, but if you ask around, first-time managers, especially in Southeast Asia, are finding it impossible to raise or close their funds. So how do you look at first-time managers?
Well, for first-time managers, I always think that the question is, what is the definition of first-time manager? First-time manager, first-time fund? Is it the team doing investments for the first time? Is it an individual? Have they worked together? I think fundamentally it's about the team that is responsible for investing on our behalf. Have they really worked together collectively, executing and implementing the strategy that they're advocating, right? There are other things that you could look at. For example, is there a pipeline of deals that you could look at and really try to test and understand, does that align with the strategy that they speak about? And I also think it's about what is the optimal size, right, for a fund. When you're starting out, it doesn't, you can start small. What we have seen, though, is emerging markets, to what you just talked about, emerging managers, it seems like some of the emerging managers have spectacular returns. And then what next, right? One needs to hold hubris in check. You're really modest because stick to your knitting, right? What you're good at, invest only in the things that you know and that you believe you can generate value, and don't have too much of a style drift. So these are things that we pay particular attention to.
Yeah. Thomas, let me come to you with a more geopolitical question. In these times where there's a lot of constraints, or there's not capital sort of put on brakes in terms of investors investing in China. How much of that, there's a lot of talk about China plus one, Southeast Asia can benefit, India can benefit, but do you actually, the examples, the data doesn't show that capital is coming to Southeast Asia. Is it because are there opportunities here, or the managers are here? Can it absorb that delta as an alternate avenue for that capital, this part of the world?
Yeah. I can see why you're asking me that. Working for CDH, there's definitely capital being redirected as we speak, invested here by GPs whose core mandate might be around China originally. I'd like to exclude myself, having been here for about 12 years, but there's definitely new arrivals on the shores of Singapore trying to deploy some of that capital that was raised previously in Southeast Asia. That's been negative for anyone who's been here because of the already mentioned overhang in capital against a very shallow opportunity set. So it's not helped as far as valuations and the necessary corrections in this environment against the macroeconomic backdrop. first question you asked, whether they will. So some of that capital gets here. We are currently at a point in time where that capital, in my personal opinion, is not invested particularly wisely. It's GPs oftentimes panicking, looking to establish themselves newly in this part of the world, trying to prove they can do Southeast Asia. In the long run, I don't think that that much capital will end up here, simply because the region can't actually absorb it. To your question, I don't think Southeast Asia can compensate for what China is now not delivering. China accounted for 60% of the activity in this part of the world previously. Southeast Asia, I think historically 10 to 15%. So how's that going to work? You can't shift Guangdong into northern Vietnam. There's not enough space. So that's never gonna. That's not going to happen. To me, that's temporary. Some of our peers will obviously diversify and expand and establish a permanent presence. But I think my view is that we, for the time being, for as long as China isn't coming back into gear, I think the total size of this market in absolute terms is going to be smaller. It's going to shrink.
Just from what you said, just one related question. As some of these manufacturing of some of these things shift out of China, is it possible for Southeast Asia to?
So there is some opportunities so there is clear connections between China and Southeast Asia, obviously. I think the two regions are becoming increasingly interlinked. We are seeing supply bases diversifying away from China into Southeast Asia, be it overseas manufacturers who are no longer putting all eggs into one basket, be it Chinese manufacturers who are saying, I rather have an asset elsewhere just in case. Their customers requiring them to have manufacturing presence outside of China if they want to continue having that business. We are seeing Chinese entrepreneurs establishing businesses from within Southeast Asia increasingly. So you have people who are moving out of China, setting up in places like Indonesia or Vietnam, and very successfully starting businesses from inside of Southeast Asia. It's surprising to me that it's taken this long, to be honest. But you think of a JNT, if you think of an ice cream play in Indonesia, if you think of businesses like that, I think that's a trend that we'll see continue. And then increasingly, Southeast Asian consumers, I think, are comfortable consuming products made in China. So be it organic or through M&A, a lot of Chinese corporates are starting to to develop business in this part of the world while they're struggling to grow their business domestically.
Yeah. Thank you. Carl, last question to you before we can take one or two audience questions. One is, when you talk to LPs, one of the terms that's often used is flight to quality. Does that mean that large firms like your Partners Group with a very long track record, operations across multiple geographies, large teams, do you therefore enjoy an advantage over, say, regional GPs or mid-market funds when it comes to flight to quality?
I think there's some truth to that, but let me just maybe take it from a few perspectives. I think in the current environment that we're in, strategies or asset classes with perceived increase in risk will probably be challenged, right? And hence, if you look, venture capital right now, I think that's one sub-segment which is probably going to be relatively challenged with a perceived higher risk profile, albeit higher return expectation. But if you look at the track record of venture capital in Asia especially, I think liquidity has been a big topic for a long time. DPI has been relatively low. So I think, that's going to be an asset class that's going to be challenged. And Thomas, no offense, but I think given the current geopolitical tensions that we're seeing between US and China, China is one of those markets that is perceived to have higher risk. And we've seen a number of our Chinese GPs really suffering in terms of fundraising in the current environment. I think everybody's taking a very much wait and watch approach to China. I think there's no doubt China is a market that you cannot ignore for the long term, but at least in the current environment where we sit, we would be better off, I think, just waiting and watching and seeing how the situation evolves. I think it goes without saying, right? A GP with a solid track record who has outperformed the market will definitely benefit disproportionately in the current environment. But I think also diversification is key, and hence having a relative value approach to investing. And by relative value approach, I mean looking across global markets, looking across industry verticals, and identifying pockets of attractive investment opportunities to invest in at relatively reasonable valuations. I think that's really what's required to deliver sustainable returns across the market cycles.
I want to take one or two audience questions. Huyang, Audrey, one of you can take it in terms of, in the current environment, do you think that more GPs will do continuation funds in Asia? I don't know, a good question from whoever it is, but yeah. What's your view on continuation funds? We're just starting to see some of the GPs do it here.
I can start first. Yes, that's been a trend. And I think it's a function of what we kind of spoke about here at the panel, which is fundraising has been challenging. And so for GPs with existing portfolio, they need to show distributions, right? Because investors are saying like, well, you want me to commit, the capital, the earlier fund commitments has not actually exited. So what do we do with that, right? And the GPs, everybody has skin in the game. Maybe it's a very good company, good business. It's just not the right time to exit. What do you do with it? Then you get into this potentially conflict type of interest situation, right? Because on the one hand, you want to make sure that part of your LPs are satisfied. They will continue to re-up with you. On the other hand, you might have to part with your beloved investment at much lower return that you underwrote it for. And there you go, you have a continuation fund. Well, you could actually sell it to someone else, I guess, or partially. But if you have a continuation fund, there are different schools of thought, because by doing that, you give your existing investors a chance to say like, oh yeah, okay, I'm prepared to stay on. I'm prepared to, hang in there and be patient a little bit more, give it a bit more runway. Usually these are also done at quite an attractive valuation, but it's a little bit dicey because you need to clear conflict of interest, and usually independent valuers will come into the picture. So long story short, is this going away? I don't think so, because we are in a difficult environment. Portfolio companies need support, they need financing. Can they borrow money? It's going to be really tough. If you borrow money, it's not going to come cheap. Well, first of all, is it available? If it is available, can you bear the interest burden for the next few years? Right? Then you look at your equity investors and do you want to be diluted, or do you want to support it for another few more years? So I don't think this is the end of it. It's going to be with us for quite a while. That's my view.
Could I just jump in there, Joji? I think you've definitely made a few very valid points, especially on conflict of interest. And I think one of the questions from the audience was, has there been success in continuation funds? And the short answer to that question from the audience is yes, we've definitely seen success. Now, success is defined on many different metrics. From the LP's perspective, what is their liquidity that they get out of the existing exposure to that asset? And success is also from the perspective of the new secondary investor coming in, and do they get a strong return from that investment? And I think that in Asia, while I would still say that in terms of continuation funds, it's still early days. It's relatively nascent in Asia, but we have seen good results across the board, both from LPs as well as GPs. Now, on the LP side, this whole conflict of interest topic is true. There is inherent conflict of interest when you're essentially selling to yourself in a continuation fund as the GP. But I think that the secondaries market in Asia has become far more sophisticated. You have very professional advisors, the likes of Greenhill, the likes of Evercore, et cetera, Lazard, who now help run essentially auction processes where secondaries investors come in, participate, put forward their best price on what that price of that asset or what the evaluation of that asset could be in order to unlock that transaction and in order to remove this sort of conflict of interest that is inherent. Also, to your point, LPs are also allowed to decide.
Yep.
Do you want to take the liquidity at that point of time? Do you want to roll? Do you believe in the next part of the growth of this asset? Do you believe that this asset is at a point of inflection and there's more to it, and there's more upside to it? So I think for all these factors, I think you're right. Secondaries transactions are here to stay. They are a liquidity solution. And we are seeing increasingly more success stories. I think Partners Group has done a relatively high-profile one with MBK in Korea, where we've basically taken one of their champion assets called BHC, fried chicken business. There is an asset, there's a shop in Marina Square, so if you're wondering what I'm talking about, go check it out. Very yummy is my professional opinion. Yeah. And that asset is sitting very nicely in terms of performance, in terms of operating performance. Why? Because that GP knew exactly what to do with that asset for the next leg of its journey, right? It knew the investment thesis better than any other potential buyer of that asset. And so for these reasons that I've just talked about, I think this is a very interesting development that we're seeing here in Asia, although still early days.
Yeah. I don't think we can take any more questions. We're already more than 5 minutes past time. But on continuation funds, any other views any of you have? And that'll be the last.
Well, I mean, I think the solution works best for so-called champion assets, as you suggested. Everything else is a game of chicken right now, because you have GPs sitting there with the bulk of their portfolio, probably longer invested than they were planning to. First came COVID, that delayed them. Then the equity capital markets started to tank. Now the economies are actually softening. So a lot of people have been seeing the IR just tick away. That's on one hand, and then on the other hand is some of us sitting there with, chamber full with bullets, looking to buy, looking to deploy capital that we raised a while back, but weren't able to, also in parts because of COVID, desperate to get that placed at fair terms, having a rather muted outlook as far as raising more capital. And so right now, there's still a material gap in expectations around value. I'm just curious who will blink first.
Yeah.
But to be seen.
Great. Thank you to all the panelists. I think we had a great first session to start the LP Summit. Thank you for joining me. Thank you all for staying. Yes.
Thank you. We'd like to remain on stage for a quick photo.